The history books are full of lies. The hospital system is not for your health. All of these things that if you had told me 10 years ago, I would have thought those are all for crazy people. Don't try to justify to yourself why AI can't take your job. What would happen if AI replaced your job tomorrow? The younger generations that are graduating college for probably the past 10 years have found homeownership mostly unattainable. The average age of buying a house now is... Hey, what is up, everybody? Welcome back to Remnant Finance. It is mid-late January right now, and it's crazy how long ago Christmas feels like. And by the time this comes out in a week or so, pretty much it'll be almost February at that point. So 1/12 of the year of 2026 already gone, and it feels like we were just welcoming in the new year. This is gonna be a solo episode, just me today. Sometimes in the past I've gone through some macroeconomic updates, or I've done some solo episodes talking through either articles or concepts that I'm reading about in the Encyclopedia of Central Banking. I've done a few episodes on that, in the idea of know your enemy, basically, right? We all understand that the central bank system is designed to work against us, even though we also directly benefit from it. And beyond the basic, just the Fed is all evil and we should just end the Fed right now kind of thinking that is very prevalent in our philosophical camp, I would say, that comes often without really any understanding of the mechanisms or what the trade-offs would be and that would entail. So I like to go through and I like to learn about as much as I can on the macroeconomic side, on the finance side. And one of the people that I read to do that, not in the vein of Know Your Enemy, that's a separate series, but someone I've referred to that I read often for valid current financial information and a way to think through changes in the economy right now is Jordi Visser. He's a former Wall Street analyst, and now he spends most of his time, it seems, working on the intersection of AI and technology and daily life, and how those things tie into investing and changes to expect. He spends an inordinate amount of time learning about AI developments. He's also a big Bitcoin proponent, and I am not a Bitcoin guy in the sense of, like, I can talk through it. I know the tech, I can give you the basic talking points, but the article that I'm going to go through today is from his Substack, and it's from the perspective of the Bitcoin original holders who are now multimillionaires, billionaires, and how there's a big sell-off from that group of what they would call whales, or the OGs. And that is a change that's kind of changing a lot of the initial sentiment, because the whole idea was hold it and never give it up. But a lot of those original wallets with a lot of Bitcoin are starting to sell now and move into the AI section. And so this rotation from Bitcoin to AI is sort of the overall thesis of this post that he wrote on his Substack. Just go to Jordi Visser, JordiVisser is his Substack. You'll find it on there. It's a free Substack. So I'm going to read most of this post. Some of the stuff that's specific to Bitcoin OGs and their view on these developments, I've removed just because it's not really my swim lane to try to convey my take on Bitcoin. I wouldn't listen to my perspective on Bitcoin if I'm you, because it's not my swim lane, right? And so I remove some of that, not because it's not important, not because you shouldn't go and find his Substack and read this post for yourself, but the main takeaways for me are more along the lines of the disruptions coming from AI and how we can prepare for that. What he calls essentially the death of capitalism is sort of the other case that he's making here. And I think it's very compelling and something that we all need to think through. We at Remnant Finance, in addition to doing life insurance and helping you set that up, helping you get that protection and savings component in place, are always trying to continue to develop our education. If I go back 5 years ago, 6 years ago, when all of the mandate madness is going down, I'm doing grad school classes online, and I have as professors, I have a lot of the people that are in charge of running the macro economy. So it was a really cool experience, but classes go online. We all know that online classes are pretty much a joke. And so I spent a lot of time reading and learning about macroeconomics. And I went through the stages of initially reading The Creature from Jekyll Island, getting really angry at the system, understanding that, everything I've been told about finance and economics is a lie, just like in medicine and health, all of these fields where many of our audience, and if they're still sticking around here, very likely you have come to this some degree of the same revelations, maybe not on all fronts, but the history books are full of lies. The medical knowledge, the hospital system is not for your health. The birth process, childhood vaccines, all of these things that if you had told me 10 years ago, I would have thought those are all for crazy people. And now they're core beliefs that I hold. And so that changed in the last 6 years for me on a lot of these fronts. And so to think that I've arrived in knowledge, even though my going from being a regular habitual reader of finance and economics for my entire adult life, that has accelerated to where I'm now consuming an amount of content that, in the last 5 years, I've learned much, much more, probably orders of magnitude more than I had learned in the previous 15 years or so. But that doesn't mean that there's not new developments. And what we desperately want to avoid is the disease that cripples the financial planning mindset, the Dave Ramsey mindset, just the buy and hope strategy, buy term and invest. All these things are crippled by the inability to take new information and make quick, timely changes when presented with new information, right? And so on the far end of that extreme, you have, someone like Dave Ramsey who owns Whole Life, but won't ever say a positive thing about it because he's built a brand on this and can't change. Who knows and would tell you, I'm sure, in person that, of course, he would take a 0% interest loan, but has to be so dogmatic against debt that he tells people, no, if someone offered me a Bitcoin, I would just get rid of it. If someone offered me a 0% interest loan, I would turn it down, right? He has to say these things that are preposterous just to kind of keep his brand going and not have his audience ask questions about the advice he's been given for 30 years, buying a house in cash, all these things. The inability to take new information when presented or when smacked in the face with it is a flaw in the process and in the value of your output, right? And so there's so many things that we have consistently hit on that are obsolete in how you should be thinking moving forward. We're going to cover a lot of those things here, like college, in my opinion, and therefore, of course, a 529 plan, not financial advice. And honestly, qualified plans. And so all these things that we pretty consistently hit on and give our takes on, and why we may or may not like certain elements of that strategy. The ability to adapt and take on new information is critical, and it becomes so much more critical now in the wake of the coming disruptions, because this is throwing what we're going through right now, what we're currently all living through, what really I would say started in earnest in 2024, accelerated in 2025, and now is shattering all economic truisms that we've held. It is this development of AI and what's going to happen from it. Now, I'm not a doom and gloom kind of guy. We're all going to be laid off living on UBI. You can find that, and you'll find everything from this is the greatest thing ever, and it's going to create much more, much newer jobs, just like every other development did. That's going to be part of this piece here, all the way to you need to buy bullets and beans right now because everything is collapsing. And so I'm not on either ends of those extremes. I think we need to recognize this is not like the development of the car. This is not like the development of electricity, all these things that create, disrupt and eliminate a lot of jobs, but create a lot of new jobs. This is not like that. A lot of these jobs are not going to go back to humans. We need to just recognize that and not be so dogmatic in our philosophy and our approach that we say, we just cannot update with new information. Take new input into your model and direct your output accordingly. So I'm going to read through this. I'm going to give my thoughts as I go. Again, this is Jordi Visser's free Substack. You can get a weekly email, and I think it's very worth your time to do so. And again, I edited some of this, just remove some parts that really aren't pertinent to the way that I want to have this conversation. And you can find all that. And again, that is what the original Bitcoin buyer's philosophy was, how that's kind of changing in the face of institutional adoption of Bitcoin. I'll say that I am I am a I am an advocate of owning Bitcoin. I have a target for one of my goals for this year of where I want my ownership of Bitcoin to be, right? But it's not something that I talk regularly about, and it's not something that I feel comfortable enough giving you a reason beyond it. It makes sense to have non-correlated assets. It makes sense to have scarce assets, and so the same arguments for gold, and silver. There's overlap there with Bitcoin. Do with that what you will, but I intend to own Bitcoin and gold and silver, and I'm not just giving up on fiat in the sense of like dollar collapse. And so let's get into this article. This is called The Fracturing Trust in Capitalism, AI, Automation, and the Inevitable Rise of Bitcoin. Okay, so Jordi Visser starts this article by saying that the death certificate of capitalism was Q3 of 2025. He says the third quarter of 2025 wrote capitalism's obituary in numbers that can't be spun when viewed through an AI lens. Real GDP expanded 4.3%, the fastest pace in 2 years. This followed 3.8% in Q2. Corporate profits surged on the back of record margins. The economy, by every traditional measure, was booming. All this despite tariff fears over the economy and profits. And those numbers have, just since quarter three of 2025, those numbers have only gotten larger. And the predictions, again, these economists, professional economists, academic economists class that's always on CNBC, when they read this economic data, GDP data coming in real time, you can see the disgust and the dismay on their face, because they want the economy to do poorly, because they despise President Trump so much that they want to see him fail, and they would cheer on the decline of the U.S. economy in order to say that. So for them to have to give him a victory, it's kind of amusing to watch their faces as they're just like, oh, are you kidding me? Like, the economy grew again. GDP is up again. Inflation's down. We've shattered these targets. We said that the tariffs were going to be inflation, like hyperinflationary and just crash the economy, and none of that's happened. And so this is not like a commentary on tariffs or Trump, but it is amusing to see how crestfallen they are when they see good economic news. Now, good with the caveat of what we're going to talk about, but undeniably, GDP is growing at record paces right now, and it's continuing to grow. They're saying that, Elon Musk is saying double-digit GDP growth is not off the table. Now, that's extreme, but he's been right more than he's been wrong, and so he's typically seems to be right, just maybe not with the timing of his predictions. So, anyways, so the economy by every traditional measure was booming despite tariff fears, but unemployment rose to 4.6%. Job growth collapsed to near zero. White-collar sectors reported net negative outlooks for the first time since 2024. For the first time in capitalist history, robust growth and record margin corporate profits arrived without job creation. All right? Record profits, robust growth without job creation. This isn't a recession. This isn't temporary dislocation. This is the system openly announcing your labor is no longer required for our prosperity. The University of Michigan Consumer Sentiment Index hit 52.9, second lowest on record, while the S&P 500 regularly makes all-time highs. Now, I'll put a note in here. If you follow economic news, the University of Michigan Consumer Sentiment Index is a deeply flawed index, because they used to try to target an equal spread of Republicans and Democrats, and now they skew so heavily towards Democrats. And so, of course, consumer sentiment for a Democrat while Trump is in office, I mean, these people are losing their mind. If he said that oxygen is good, they'd stick a bag over their head. I mean, they've gone full retard in light of Trump. And so these are not, in my opinion, like, liberals are now not sane people. They're not like people who just have different political views. They've become so deranged in their hatred for him that they will, again, cheer on the destruction of the economy, just openly welcome their destruction and mass migration, just to make Trump look bad. And so I don't that caveat is to say that the Michigan Consumer Sentiment Index of 52.9, the second lowest on record. Sure, I mean, that's true. That is the second lowest on record, but it's probably skewed politically by people that will never ever give Trump a win ever. So, but feel, you see how you feel with your own, with grocery prices, with, like, you can gauge your own sentiment of the economy. And I'd say most people are very uncertain. And so even though inflation is not where it was, gas prices are plummeting, the asset prices are at all-time highs, and so you might feel pretty good, but how certain do you feel? Only you can really gauge that. But it is also undeniable that while consumer sentiment, at least according to this flawed index, is the second lowest on record, the S&P is regularly making all-time highs. This divergence isn't paradoxical. It's cause and effect. Markets celebrate efficiency. Workers experience efficiency as termination. The economy's success metrics now directly correlate with human obsolescence. So again, markets celebrate efficiency. Workers experience efficiency as termination in this economy. This is the moment the social pact, the 10,000-year bargain between labor and capital, officially died. People can politicize all of this, but the reality is clear. We just witnessed capitalism aging rapidly. Next section, the original bargain. For context, understand what just broke. In 8000 BC, the plow created surplus beyond subsistence. That excess freed humans to become artisans, merchants, builders. So everyone that used to have to farm just to live, not everyone needs to farm anymore. So now that surplus of food allows people to do things other than farm. Artists, merchants, builders. By the 1800s, the Industrial Revolution replicated this pattern. Factory wages exceeded survival needs, creating disposable income for savings and home ownership. The steelworker's son could become an engineer, the engineer's daughter, a doctor. This wasn't altruism, it was mechanical necessity. Corporations needed skilled workers. Workers needed rising wages to become consumers. Governments needed tax revenue from both. The pact worked because everyone needed everyone else. A generation ago, a college degree was a passport to upward mobility. Work hard, compete well, secure your position. Today's graduates carry six-figure debt into a labor market. This is huge. This is the foot stomper for me. Today's graduates carry six-figure debt into a labor market where the new competition never sleeps, never tires, and gets exponentially smarter every 6 months. The meritocracy promised your effort would be rewarded. The new reality, your effort is competing against entities that don't experience fatigue. I'm going to read that little passage again because it's so critical. A generation ago, a college degree was a passport to upward mobility. Work hard, compete well, secure your position. Today's graduates carry six-figure debt into a labor market where the new competition never sleeps, never tires, and gets exponentially smarter every 6 months. The meritocracy promised your effort would be rewarded. The new reality, your effort is competing against entities that don't experience fatigue. Even before the AI element of this, there was two distinct experiences of the economy. Young people right now, the younger generations that are graduating college, for probably the past 10 years, have found homeownership mostly unattainable. The average age of buying a house now is 40. Now, your instinct, if you're, just like general conservative, your instinct is like, well, yeah, they're becoming liberals, they're becoming blue hairs, they're getting worthless degrees. And so, yeah, you have no marketable skills. You're not becoming a doctor, an engineer, a lawyer, or whatever. You got a degree in gender theory. Yeah, of course you can't find a job. And there's some truth to that. But regardless, now your engineers, like computer science and coding, is not a job anymore. That's a broad generalization, but I can code now. I don't know anything about coding, and I can code now. I used AI this past week to create a bot that would log in to Kalshi and Polymarket, which are essentially like betting on current events apps, betting on anything, apps or websites. They could log into my account, automatically every 10 seconds find the same bets between the two companies, find if there was an arbitrage edge. If there was, it would send me a notification on my computer, but only if the percent net gain was over 6%. There is the fees from each of these. And so the idea was, if I get an alert, that alert is telling me that if I place the same amount of money on the same outcome, and this is like current events things, right? This is like, will Trump invade Greenland by the end of 2027 or something like that? Yes or no? If they find an area where you can make the same bet and get a guaranteed payout, and that payout is at least 6% after factoring in the fees to make these wagers, I'll get an alert, and I could log in and I could place the bet and guarantee a profit, right? I don't know anything about computers and coding and any of that. I just told AI, I told Claude, here's what I want to build. How do I start? Assume I'm 5 years old and I don't know anything about coding. And it was like, all right, open up this file. Do you see this? Yes or no? Like, it stepped me through it. It took me 12, 13 minutes to do that. Now, and then at the end, I tried to log in and actually go to Polymarket, and they don't serve US customers, right? So I'm going to wait and do this until I actually get, until I get, and Polymarket allows US bettors, basically. They don't right now, right? But that's just an example. I'm not a coder, but that would have been something that people would pay for. That would have been a job for somebody to do. And Claude did that for me in a matter of minutes. I literally got like a test, and it blows my mind. It popped up on my Mac and it said, deal alert, like bet on this, just as an example. So I hit a roadblock there, but that is to say, these jobs that people are getting, or the degrees that people are getting with the expectation of getting a job in that field, can so quickly be replaced, as evidenced by the fact that I created an arbitrage bot that plugged into the API of two companies to find an edge for me every 10 seconds scanning, and it expected it would find 1 to 3 notifications a day. Like, that's insane, right? And so I'm going to read this one more time. It's that important. A generation ago, a college degree was a passport to upward mobility. Work hard, compete well, secure a position. Today's graduates carry six-figure debt into a labor market where new competition never sleeps, never tires, and gets exponentially smarter every 6 months. The meritocracy promised your effort would be rewarded. The new reality, your effort is competing against entities that don't experience fatigue. 2025, the year capital divorced labor. Q3 2025 is the inflection point because it reveals what AI actually does. It severs capital's dependency on labor entirely. This is a critical distinction as you shape your own views. Capital still needs labor, but it doesn't depend on it. Capital still uses labor as a tool for convenience, but it no longer relies on labor as a requirement for growth. Previous technological disruptions, the plow, the steam engine, electricity, eliminated specific jobs but created surplus that funded new roles. Farmers became factory workers. Factory workers became office workers. Each transition maintained the core bargain. Work generates value. Value generates wages. Wages generate investment surplus. AI breaks this chain. Digital employees don't just replace workers. They eliminate the need for the worker-consumer economy that capitalism requires. When corporations generate record profits with shrinking workforces, they're not optimizing the system, they're transcending it. Growth without jobs isn't temporary friction, it's the new permanent state. Every quarter forward will show this pattern. Productivity up, profits up, employment down. The divergence is the point. Why this time is different, the competition that never stops. Listen to 100 podcasts about AI and labor and you hold the same tired binary debate. Will AI replace all jobs? Followed by, no, new jobs will always be created, just like every previous technological transition. Stop. This framing is fundamentally wrong. We have never had machines smarter than humans that can walk like humans, work 24/7 without fatigue, and compound their intelligence every 6 months. This isn't the Industrial Revolution 2.0. This isn't even about job replacement. This is the introduction of an entirely new competitor for labor, one that operates under completely different rules than any workforce in human history. When machines transcend human capability, they don't just replace the worker, they dissolve the 10,000-year bargain that tethered capital to labor, forcing the disrupted voters to demand a government that no longer manages a market, but governs a transition into the post-labor area. The narrative that AI is replacing jobs misses the psychological devastation of what's actually happening. AI isn't replacing jobs, it's introducing an unlimited supply of competition who just graduated from digital university, work around the clock, and level up faster than any human can. 2025 marks the transition from AI as tool to AI as workforce. 2023-2024, models and experimentation. 2025, product deployment at mass scale. 2026 and on, mass workforce competition and eventually human form. This isn't automation in the traditional sense. It's labor market flooding. When 1 million digital analysts can perform financial modeling simultaneously, human analysts don't get replaced. They get outcompeted by entities that don't sleep, don't negotiate, and compound their capabilities faster than any human can learn. Yes, people will still have jobs, but here's the uncomfortable truth the optimists won't say. Trying to compete with only a college education will not work going forward. The 4-year degree that once guaranteed middle-class stability now puts you in direct competition with digital entities that possess the equivalent of 10,000 PhDs, work 24/7, and improve with every software update. The psychological impact is devastating for anyone raised in the meritocracy. You were taught study hard, get good grades, be number one, and you'll win. That competitive gene, the drive to outwork, outsmart, outperform, was the engine of capitalism. It created the achiever class, the strivers, the ambitious. Now you're competing against entities that process information at speeds you can't match, remember everything they've ever learned, and improve at exponential rates while you sleep. You can't outwork something that doesn't experience fatigue. You can't outsmart something that's getting smarter every model release. You can't be number one when the competition has no upper bound. This isn't about losing your job to a machine. It's about realizing that the entire framework you were sold, effort equals reward, competition creates opportunity, merit determines outcomes, has become mathematically impossible to sustain. The game didn't end. The rules changed to make human victory structurally impossible. When 98% of humans stopped farming, they became customers for industrial goods. When AI floods the labor market with infinite competitors, displaced workers become what? The safe jobs, elder care, nursing, childcare, pay wages below survival, let alone investment surplus. You can't save for retirement on $30,000 while paying $15,000 for childcare. This creates a death spiral. Governments lose tax revenue from workers who can't compete. Corporations lose customers. Consumption collapses. The response? Print money to stimulate demand, debasing the currency that was supposed to store value across generations. The social pact promised: work hard, save wisely, build enduring wealth. AI makes that sentence grammatically impossible. There's no work that generates surplus when you're competing against entities that operate at near zero marginal cost. There's no savings vehicle that holds value when governments print to sustain consumption. There's no wealth to transfer because the mechanism that created it, labor scarcity, is gone. So this is why, to me, we're so such. I love in reading this. You might think that well, why? Okay, you're saying that a lot of things don't work anymore. Why would we still be doing whole life insurance? I love this asset because I know that when I die, I am turning those dollars that I had put into this policy into many, many, many more that will go to my wife by contract, guaranteed, my daughters, tax-free. And so I'm multiplying my money in a manner that I simply can't do with an investment, right? Now, while I'm living, people like to compare my cash value growth to an investment growth, but the ultimate multiplication is when I pass. And so the ability to continuously put money into a vehicle that has guaranteed growth and like all of the things that I am seeking when I look for where my savings are going to be, this asset shines even brighter in the light of this in my mind. That protection piece, the savings piece, and then the ability to go and grow it. But again, we've made this point a lot recently. We're big advocates of going and growing that capital. You need to do something to continue to grow because he's right that like your field might be going away. Your labor might be going away. And so you need to have your money work for you. Your money needs to be your job. And even more so, like we say, you have your primary job and then you have your job as a banker. Well, that's true, but let's envision a world where you don't have that primary job, where your primary job is taking your money and earning more money. Now, is this a healthy system? Is this a good thing? Is this sound money? No. But at the end of the day, like you don't get a decision on if sound money returns to our economy, if sanity returns to our economy. You don't get a decision if Congress decides to stop spending, or if they're going to just keep it going forever, right? We don't get decisions on that. So all we can do is understand and maximize for our families. And I am maximizing, I'm trying to optimize with the expectation that they're going to continue to pump money in. Now it's doing it to basically uphold the kind of like prevent the bottom from falling out here. But these things are changing. Like, this is deflationary stuff, right? Because if people can't earn money and they can't spend money, prices could go down. There's no like, because of this, we should expect exactly this to come. We don't know what's coming, but we know that we can prepare. And so, I am really, really making an intentional focus this year. Like, I always invest, I always save, and protections in place with my life insurance. But I'm really making a conscious effort to be very direct and intentional with my investments and where it grows. Because I've tried a lot of different things just in 5 years of doing this, of learning about different opportunities and where money can go. And so I really want to make sure that I'm not leaving any opportunity, or I'm not leaving anything on the table as far as what these dollars can be doing. And so again, my portfolio right now looks like rental properties, looks like gold and silver, the physical variety, not the paper variety. It looks like crypto, and it looks like my options trading account at the moment. And so I'm really leaning into that because I want to continue to grow, because my job, like Brian and I are kind of this unique job that we're creating this company. And there are, this is like our niche of the financial services realm. And I think that ours is a lot safer because ours is dependent on our ability to convey these concepts, and it's just going to take a long time. I mean, if you know insurance companies, one of the frustrations people have is that it takes, they're kind of clunky. They're not up to speed with the times. Well, that might be a strength when it comes to implementing a lot of these changes that are coming. And so, whether this, I plan to do this job for as long as I'm alive. I love it. I love doing the education piece. I love continuing to learn about this stuff, and I love conveying it to anybody who will listen. I also love learning about insurance, and I like helping people, and now getting some proof of concept, seeing clients with policies a couple years in and what they're doing with it. I like seeing and knowing that we are making a difference on people's lives. So I'm going to continue to do that, but I'm also not going to just assume that, like, don't try to justify to yourself why AI can't take your job, right? Play through the worst case scenario. What if it goes away? And so, that's where we need to be really intentional about where we save, and we save in a guaranteed growth asset. And I look at the future of my policy and the dividends that I'll be getting, and the tax-free growth, and all these features of it that I love on the living side of things. And I know exactly where I'm going to be in 10 years, 20 years, 30 years with that. I don't know how my options trading portfolio is going to look. I'm hoping that everything holds as it has for as long as the short time I've been doing it. And we can expect that the market's going to continue to generally rise, because again, the whole thesis here is, if we're talking about pure efficiency and profit maximization, the more employees you can hire, the cheaper your costs go. And if those employees are replaced by a technology that doesn't sleep and continues to train all the points you just made there, profits can only go up from here, you would think. And so there's a lot of variables at play, but I'm going to continue to trade my strategy with the options. I'm going to continue to acquire rental properties. I'm going to continue buying gold. I'm going to continue investing in crypto, and trying to be smartly allocated with this. I think that this protect, save, grow framework plays out very nicely in these coming disruptions. But do not fall into the trap that your job is untouchable here, because just think through the worst case scenario and how it could go. All right, back to the article. The squeeze accelerates. Why numbers lie. The official poverty line sits at roughly $32,000 for a family of four. Michael Green's viral analysis revealed what everyone living paycheck to paycheck already knows. That number is a statistical fiction designed to minimize the visible crisis. Now, he's referring to an article that came out fairly recently and got a lot of attention in the macroeconomic space. I've heard it kind of debunked, that the numbers that he uses, there's a lot of assumptions made that you might not agree with, but regardless, it was a very rhetorically powerful article, if nothing else. It says Green calculated that if you update the original Orshansky poverty method with modern spending shares, the real threshold is $130,000 to $150,000 for a family of four, not $32,000, not even close. He calls the current line a deception and shows how benefit cliffs trap families in what he terms the valley of death, where earning $40,000 to $100,000 can leave you worse off as subsidies fall faster than wages rise. So essentially, there's the reason why so many people try to get below that limit, because you get so much free handouts, you get so many subsidies, and if you go above that, you start to lose them and they fall off quickly. I don't know. I don't buy that $150,000 for a family of four is the poverty line. I really don't. I mean, I know that would be tougher to do here in San Diego than it would be in like Arkansas, but I just don't know. Like, I know a lot of people here making $150,000 a year, and they're fine. So I don't necessarily buy this number here, but I do buy that 32,000 is way too low. It's definitely higher than that by the metrics that they're evaluating. But here's kind of the more important point. Besides that, forget the number, but independent living wages calculators confirm the squeeze. Even 70 to 90,000 often only covers bare bones survival in many U.S. metros with no margin for savings. That's the key there. Again, even $90,000 being bare bones survival, that's hard. You know what it's like in your city, but here that's not too far off. But like bare bones survival is a little that's a little extreme. But that is the key there. No margin for saving. Like, you could even live comfortably. You could live comfortably in $90,000 in a lot of places, and even here in San Diego, you could. But the margin for saving, and can you really do much more with the money besides that? Even if you have a comfortable life, like, are you able to save and invest? Below that, you're not building wealth. You're treading water, and most American households are drowning. This isn't just about measurement error. It's about what happens when asset inflation, stocks, real estate, Bitcoin, runs ahead of wage growth for decades. A nurse earning $65,000 in many metros can't afford median rent where the hospital operates. Teachers with master's degree qualify for food assistance. The middle class is functionally poor by any honest accounting. This creates the perfect collision. Digital competitors arrive to flood the knowledge work labor market precisely when most workers have zero savings cushion to weather displacement. The economy requires rising wages to create the consumer base that sustains it. Asset holders need wage suppression to maintain profit margins, and now AI offers capital a way out. Infinite labor supply at near zero marginal cost. And so, just to unpack that a little bit, the economy requires rising wages to create the consumer base that sustains it. So we need people to continue to make more, to consume more, to continue to grow the economy. But then if you're an asset holder, if you own a company, like all of these companies, the Mag 7, like if you're an investor in the S&P 500, you're effectively an investor in 7 companies, and they're all tech and AI heavy right now. And those require fewer people, right? The Meta and these large tech companies that are pouring a ton of money into AI, they're building the infrastructure that's replacing their own and other employees. And when they do that, they're increasing their profit margins. And so they're basically saying that the economy needs us as consumers to have rising wages so we continue to spend. But those who own assets need less wages, because fewer wages on average means fewer employees in that equation, and therefore increased profit margin. And so here comes AI in 2025 offering capital a way out. Infinite labor supply at near zero marginal cost. When Green's analysis goes viral, it's not because he's discovered new math. It's because 60% of Americans finally see themselves in the numbers. The system was already failing to generate investment surplus for the majority before digital employees arrived. AI doesn't break a functioning pact. It accelerates the collapse of one that was already fracturing under the weight of its own contradictions. This is why consumer sentiment sits at near recessionary levels while GDP posts solid 3 to 4% growth. The official statistics say the economy is booming. The population's bank accounts say they can't afford to participate in that boom. And unlimited digital competition is about to make both statements permanently true at the same time. Read that again because it's so important. The official statistics say the economy is booming. The population's bank accounts say they can't afford to participate in that boom. And unlimited digital competition is about to make both statements permanently true at the same time. Progress is not binary. Just as all workers will not lose their jobs, systems don't end cleanly and then begin anew. They merge, they overlap, they create transition zones where the old and new coexist in uncomfortable tension. We're living through that merger right now, what some call the fourth turning. Again, so that's why it's not just like all truck drivers are going to go away tomorrow. All pilots are going to be replaced tomorrow. These things are going to happen incrementally. Now, this pace of change is faster than previous replacements. The internet, 30 years difference in the internet is an enormous night and day difference. That same difference, what takes 30 years to develop in the internet timeline, could take 6 months with AI. So things are happening quicker, but it's not just that everything changes at once and now we go from like this structure to this structure in the economy. Like things are changing, but there's going to be overlap, and so it's not this clean break. Consider the forces colliding. Demographic wealth transfer, the largest intergenerational wealth handoff in history as boomers age out, and political realignment. Young people who never participated in the old system are voting for governments to support crypto, reduce intermediaries who captured wealth, and now critically protect them against robots taking their jobs. This is strategic positioning for a world where systems don't replace each other cleanly, but rather merge in ways that create asymmetric opportunities for those who understand both. The young voter demanding government support for crypto, while simultaneously demanding protection from AI job displacement, isn't contradictory. It's necessary diffusion that happens when an alternate system becomes mainstream. And so my understanding of that paragraph there is like, well, why would you as young people vote to support crypto when crypto is kind of part of this, the driving force, like the head of the tip of the spear here that's bringing in the AI that's displacing everything. So why would you're supporting crypto, which de-emphasizes financial institutions. It de-emphasizes a lot of it gets around a lot of the financial middlemen. Well, in doing so, you're bringing in AI, and so that is now. But at the same time, you're trying to push for protection from AI while you support crypto, and that it does seem contradictory. But he's saying that that's basically a necessary diffusion when an alternate system becomes mainstream. It's like both of these things are happening, and so you're going to want the one that helps you, which is crypto, which is because you've been effectively, younger generations are being priced out of enjoying the asset growth that previous generations were able to basically just fall into by going to college, getting a job, working, having enough wage growth to not only meet subsistence, but also live a comfortable life and save and invest, buy a house when they're cheaper. And now like this surge, the tide of inflation, the tide of asset prices has gone so high, while wages have I think last I saw was like over a period, I can't remember the exact period they were talking about, but asset prices are somewhere in the ballpark of 30x over this long, decades long time period, and wages are 8x. And so the younger generations are left behind. They're not part of this system. Like this idea, what we call capitalism, which is not what we call capitalism, this system that we have, it does not work for them, and it's not going to work for them. And so that's why you're going to have more and more discontent with it. And those younger generations, where home ownership is off the table for them in large part, statistically, the average age of purchasing a first home now is 40 years old. That's crazy, right? That's not just like you guys just need to pull yourselves up by your bootstraps and don't get a gender studies degree. That is not what's happening here. Like the system is not working for younger generations, and so it is contradictory to support crypto, which allows them kind of an in to get a moonshot on a meme coin, or just to invest in Bitcoin and some of the larger original coins that are transporting value through time, while at the same time wanting protection from AI. It's like you can't have one without the other. You want your cake and eat it too. But who doesn't want their cake and eat it too? So but regardless of like what we think about that logic, that is what the younger generations are doing. Just as AI competes with workers, it will also compete with the process most critical to the capitalist system: idea to monetization to moat. The entire venture capital model depends on companies building defensible advantages over years: proprietary technology, network effects, brand loyalty, regulatory capture. Just all of the things that a company needs to go through when you have this idea. So proprietary technology, you need to develop something, you need to have an idea and put it into put it into effect in a way that you can monetize it. You get the network effects, you get brand loyalty, and then you get as the regulatory capture, as he calls it. So, for instance, and this is a great example of this. Actually, let me finish this, but then I'll go with my example. AI demolishes this timeline. When the coding barrier disappears and development speed increases 10x, intense competition arrives faster than moats can form. Companies will rise faster, yes, but they'll also fall faster as competitors deploy identical solutions within months and eventually weeks or days, not years. So I have two examples here. So if you track AI, if you track the developments in it, and I get a daily newsletter called Superhuman, and it's a guy that just puts out like I skim it. It's a 3-minute read for me every morning. I skim it. I look for tools that might help, and I just try to get an idea, generally speaking, high level overview of developments, right? But one that's been all over X, it's been all over the newsletter I get, is Claude Cowork. So Claude is the AI tool that I use. Chat GPT. You've got what else? Grok, and then Claude is one of the major like LLMs, right? So I use Claude. I try to use it every day to help with something or ask a question. I use it for tracking my goals, etc. But they have Claude Code, which is for coders, where coders can go in and basically get apps and stuff built, do different things, but it takes some knowledge of coding. But now they've created Claude Cowork, which is a paid subscription if you have the pro account. But for $20 a month, you now have Claude Cowork, which can go and do these coding things at a conversational request. So to test it out, I just said, hey, my desktop is a mess. I just said, hey, organize my desktop. I see windows moving, everything's moving, and now I'm looking at it right now. I have a clean 4 folders on my desktop. I have iCloud, I have OneDrive, I have all these places where information's stored, and it kind of drives me. It's like a daunting task for me to organize this. I said, hey, find everything from both iCloud and OneDrive that's Navy, put it into one consolidated Navy folder. Now, if I look in it, I can pull it up right now. I have a Navy consolidated folder. I said, all right, within this folder, organize it into the mandate fight, into admin stuff like orders and move and all this paperwork stuff that I probably don't need anymore. But like, it moves all this stuff into here. And now the clutter is so much less. I don't have all of these screenshots and stuff on my desktop. Like my work just became so much more organized, and not because I know how to do that from coding, but because the Claude Cowork function is powerful enough that just by saying, hey, can you organize this folder? It then goes and does the coding needed to make that happen. So Claude Cowork, among many, many other functions, brings coding to someone like me. Again, that example of like building that bot. Within a week, there was 2 different competing versions that are offered the same service for free. One is Goose, which is Jack Dorsey's project. His company, he has a new company, and they offered this service called Goose that does Claude Cowork, but it's open source and it's free. And there's another one, I can't remember who, but basically within a week, this major disruption that is just dominating my Twitter feed now has 2 competitors that do it for free. And so here's another example. Remember when Uber's coming online and taxi drivers are realizing their model is totally outdated, they're going to need severe government intervention to exist at all, right? They required New York City to, they like, all right, the city of New York is going to allow for Uber. We can't deny this innovation. This is so much better. It's so much cheaper. It's so much safer. Like everyone prefers Uber to taxis. Nobody, even taxi drivers, like I'm sure as customers, maybe they do it to, take a taxi by choice just to support each other. But like no one prefers a taxi where you get in and you have a Moroccan driving you that doesn't speak English and doesn't want to take a credit card, and you don't know how much you're going to be charged. You see this ticker going up, like compared to getting into, using your app, having someone you can talk to on the app, having support you can talk to if something goes wrong, being able to see exactly the driver, having this digital record of your trip if you ever need it, any kind of, I don't need to sell you on Uber over a taxi, right? There's a reason that taxis went away, except they needed the government to say, except in New York City, because they're so heavy there that we're just not going to allow Uber there, right? And so remember the riots, remember the protests, remember Uber driver or taxi drivers killing themselves because they have their medallion. They're never going to get out of this debt because Uber just came along and disrupted their entire model. And that fight took a few years, right? But now taxis are pretty much like, there's an airport line still at San Diego, or a taxi line still at the airport here, but I never see anybody there, while there's a ton of people waiting for Uber and Lyft, right? Well, now Tesla is designing robo-taxis that are going to be much more efficient. Tesla drivers are going to be able to basically, with a software update, from what I understand, they'll be able to take their Tesla, they drive it around, then it parks itself. They can just hit a button, or they're going to be able to hit a button, which will allow their Tesla to be essentially a self-driving Uber in the Tesla network. And so I think that it's going to be Tesla owners that can go and request a ride, but I think eventually it'll be all users. Just like you log into Uber, you'll be able to request a robo-taxi from Tesla, and that's someone else's. That's Joe down the street's Tesla, where he's not using it and he's making money while his car is otherwise sitting idle because it is doing its own driving, right? There's also the self-driving cars are going to be able to park themselves. And so there's a startup that's totally disrupting the parking lot industry, which is an industry, of course, because self-driving cars can go and park themselves much cleanly without accidents and much tighter, right, than humans can do. And so all these things are happening. And so now, guess what? 10 years later, Uber and Lyft drivers are protesting, right? They're out in the streets of San Francisco demanding protection from the robo-taxis because they're about to be displaced. So taxi drivers, so the chain of events here from, horse and buggy, now we have this new technology, and it slowly takes, it wasn't just this quick, like now cars are out. It started as a military function initially, and then it started to develop where consumers are able to get cars, but it's only wealthy people, and eventually everyone has a car. That changed from horse and buggy. I don't know, I'm ballparking here, but that might have taken 30 years from where it was mostly horse and buggy to mostly cars. No idea what the actual timeline was, but it took a long time, right? It wasn't like mass adoption. Now everyone has cars. Well, taxis become a part of that, and now taxis are everywhere. Taxis are a common way to get around when you don't have a car, and now taxis are almost entirely gone, but that took 10 years, right? In those 10 years, we're now having the Uber and Lyft drivers facing their job being replaced because robo-taxis are coming, and they're going to be safer 400 times, is the studies that I've read, safer than human drivers. Will there be accidents? Yes, but will they get better and better? So like that example of the fact, it's just kind of funny to think, and I get why Uber and Lyft drivers are scared for their jobs because those are going away. But they were the ones that were the disruptors 10 years ago or less. They were the ones that people were protesting, that taxi drivers were protesting, and now they're going to become obsolete. And so this timeline is compressing. All right, back to the article. This speed will disrupt those attempting to chase the winners. By the time you identify the next big AI company, 3 competitors have already emerged with better implementations. 3 forces collide in 2026 to make the fracture undeniable: AI deployment acceleration, political reckoning, institutional capital rotation. So AI deployment acceleration, job losses move from projections to quarterly earnings reports as workforce optimization. Abstraction becomes termination. Digital competitors move from prototype to production scale. Political reckoning, when democratic socialists win elections on explicit platforms rejecting market solutions, as Mamdani did in New York, it signals voters concluding the pact cannot be repaired through incremental reform. If this spreads in U.S. midterms, it's a mandate for systemic replacement. Institutional capital rotation, when pension funds managing retirement security for millions diversify into Bitcoin at scale, they're declaring no confidence in the system they've upheld for decades. Traditional finance admitting the pact is broken violates the hedge thesis permanently. 2026 won't break the pact. It will be the year the break becomes too obvious to deny. The choice, architecture or ruin. The question is not whether the old pact survives. Walk through any city, homeless encampments beside luxury towers, record profits amid record pessimism, degrees that guarantee debt but not employment. The pact is already dead. You're living in the fracture. The fracture isn't coming. 2023, Q3 2025 already delivered the proof. Capitalism can now generate wealth without workers. Every institution built on the opposite assumption, governments, pension systems, education, real estate markets, now rests on a foundation that no longer exists. When capital divorces labor permanently, when digital competitors flood every market, when GDP surges while sentiment craters, what stores value for a future of abundance? Not currency backed by productive workers, not bonds issued by governments losing tax revenue, not equities in companies that no longer need customers with intense competition. The rest of it is about the Bitcoin OGs, and so I'm not going to hit that because, again, I've gone on for almost an hour now. I think I've kind of made the same point like 10 times, so I apologize, but I know this is repetitive, and I know we sound like a broken record, just continuously saying that you need to protect, you need to save, you need to grow, but you really do need to do all those things, and you need to be thinking through all aspects of how this can change for you. Like this is a super powerful tool. It's blowing my mind how impactful this is just in my life and what it's going to be continue to do. But I also see there is going to be major disruptions coming. We never see these black swans ahead of time, and then you look back and you're like, oh man, I wish I had positioned or hedged myself differently. And so try to see this one coming, because I don't know that the black swan is the right term here, because we can all see it coming, but like how it's actually going to play out, I think is still so much up in the air. And so grow your portfolio, make sure that you are in the class of Americans that has assets that will benefit from asset price inflation. And even though this all sounds like doom and gloom, I said in the beginning, I'm not a doom and gloom guy. I'm not like an AI is going to destroy us. Fiat currency is just going to zero tomorrow kind of mentality. I know I said that at the beginning, but then the whole article kind of makes it sound like it is. But in reality, like look around your town. Like the post office is there. It's not like those cars aren't just, the post office vehicles aren't just going to stop. The mail is going to continue to circulate. The restaurants are going to continue to serve food. Like they're going to go out of business and other ones will come up. There might be changes like the ghost kitchens. And now it's like there's going to be probably unimaginable changes for most of us of what we're going to see, but we're still going to be alive. We're like, houses don't just crumble, right? We're like, we will adapt, and we'll figure out in light of these new economic realities that like how to continue to thrive, right? I don't think this is not like the end of the world. It's just we need to really understand that when businesses can become more profitable by laying people off, we should just intuitively expect a lot more layoffs. And so I'll sum it up with, when you look at those charts of who owns the asset, the 1% own, whatever X% of the wealth, right? As disheartening as that is, like, which side of that equation do you want to be on? I want to be on the side that owns assets. Like, I can help my family and more people around me if I'm on the side that owns those assets. And so if those assets are going to inflate, I want to own them as well. And so let's just think through what would happen if AI replaced your job tomorrow. How are you buffering for that? How are you building out your runway? I'll tell you right now, one of the things I'm doing is I've always strived to keep 6 months of expenses, and I chart out my runway and I track our daily burn rate, mainly by tracking monthly expenses, but then calculating that out. All right, here's what we're spending each month on average in all these categories. Here's our fixed expenses. Here's our non-fixed expenses, right? What is the total I'm spending in a given month? And now I put that out, track that out to a year. Over the course of the year, here's what I think we need based on our current consumption. Divide that by 365. That's my runway. That's my daily burn rate, right? Or sorry, that's not my runway. That's my daily burn rate. That's how many dollars a day we're going through to maintain status quo. Now take my emergency fund and divide that by the daily burn rate. That's my runway, as I like how I refer to it on my spreadsheets. I calculate my runway that way. I'm at 220 days right now based on our current expenses. Now, if things really hit the fan and income just plummets and I get replaced by AI, we're going to be trimming a lot of things from the budget. There's a lot of discretionary spending. We're going to be doing a lot less spending if that happens. But when I'm planning as if nothing's going to change. I'm not canceling any subscriptions. I'm not changing, switching to lower prices on groceries or anything like that. Changes that I might make if we really got into a situation where I'm not earning, that would decrease that daily burn rate. When I'm planning for my actual runway, I don't plan for any of those changes. If nothing changes, exactly how we're spending now, how long. And so I keep my current emergency fund balance right now is not in terms of dollars, it's in terms of days. And I continue to update this every month. And I use Claude to do it. I just upload statements for my credit cards and my bank account, and it analyzes it all for me, tells me exactly where I'm spending, tells me exactly the income, everything like that. So I'm using that tool. And I've decided, just the more I read about this, my biggest takeaway from all of this for me, besides continue to invest, continue to understand where I'm investing, continue to save, is on that saving piece. I'm going to try to get to a year of runway, and then I'm going to try to get to 2. I was talking to Brian the other day, and he's trying to build up to 2 years of runway. And so I think that as long as you're continuing to learn and you're continuing to stay ahead, and as long as you maintain the idea that you don't know it all, and when new information surfaces, put that into your input model and adjust your decision-making behavior, that's all you can do. And so in the vein of education, I think I've gone on long enough, but I hope that this concept helps you to think through a little bit what might be coming, and maybe hopefully shakes you out of some of the some of the propaganda and the rot from the financial planning industry that I think is going to leave a lot of people who are dependent on, you know, like if you have a stock bond allocation portfolio and that's your strategy, good luck. I think that we're going to need to weather a lot of storms here, and what those storms exactly look like, I don't know, but I know that you can strategically position your assets to be able to both capture the upside and hedge against the downside. And that is not just a diversified stock portfolio, in my opinion. There's a lot more to it. So if you want to talk through what I'm doing, if you want to just, you know, put your cards on the table and see what we're working with and how you should be thinking through this, we're happy to do that call. If you're interested in a whole life policy for the purposes of protection and savings, for all the benefits we talk about, just hit the scheduling call below. We're happy to talk through all that. But until next time, I'll be back next week with Brian, and you know, we'll be talking about something hopefully a little bit more uplifting. But we should not shy away from information that is uncomfortable just because it, you know, comfort is a nice stasis, but it's not where we need to live. We need to be continuously staying on top of things. So, all right, yeah, hope that's helpful, and we'll talk to y'all next week. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.